Hello, and welcome to the second part of the lecture on the GASB's project on revenue and expense recognition. So in this part of the lecture, I'm going to talk about what the board has been doing since getting comments on the invitation to comment, primarily developing preliminary views to expose for public comment for a second of ultimately 3 rounds of public comment on the project in June of 2020. The board received 55 written responses from individuals and organizations to the ITC, and 25 organizations and individuals from that group also testified at 3 public hearings. I think that's probably a little bit lower than the board would have liked, but 2 things were working against it. One, it's a complex topic, and at this stage, rather esoteric, and therefore kind of hard for people to grasp and really to concretize in terms of what the personal impact would be for them and for their governments. And also, that very same issue there, when you're at an early stage of a project like this, it's sometimes people don't realize the importance of providing feedback. Some want to wait until the board has actually proposed some changes to the standards, even though the board really makes an effort to communicate that this is the stage in a project where you can probably have the most significant impact on the board's direction, because at this point the board hasn't made even a preliminary decision about what direction it wants to head. And so the field's open here, and the feedback that the board gets at this stage of our project really helps to direct where it's going to go and how it's going to respond when it comes out with its next round of proposals. And the closer you get to the final statement, obviously the firmer these decisions become on the part of the board, and the harder it is for the board to reverse them based upon public comment. So this really is an important time to provide feedback. Speaking of providing feedback and direction to the board, I'm not sure the board got a ton of direction from this feedback, because every model received some support and every model was criticized. I think most broadly, the people who were supportive of the exchange non-exchange approach liked it because they knew it. It was familiar and it wouldn't require any change or very little change. On the other hand, those who liked the performance obligation or no performance obligation approach liked it because they thought that the only way that the board was going to be able to address the issues that existed was to develop a new model. So what the board decided to do was to perform some additional analysis, and it didn't start from scratch, but it did at least reconsider, as it normally would during redeliberations, all of its decisions, but it maybe did it on a more fundamental level. And one thing that also happened as a practical matter at this time was that the person who led the project up through the invitation to comment retired. And the person who replaced him is a very different kind of project manager, and I wouldn't say better or worse. She certainly is far less experienced than he was as a standard setter. She's only been at the board for about 5 years now, but she has a different analytical approach, and she likes to really dig into the foundational underpinnings of the work that she's doing. And so she led the board through several months of discussions about fundamentally what it was trying to accomplish with developing this model and what this model needed to include. So a lot of that analysis really focused on which categorization models or methods were appropriate and were functional and could suit the needs of a comprehensive comprehensive model for recognition of revenue and expense. The exchange non-exchange categorization method, one of the primary problems here that makes it unsuitable is its focus on this notion of equal value, because value is a subjective concept. And once you've got something as subjective as that involved, that's problematic from a standard setting perspective, because subjectivity is not standard, it's non-standard. It's the opposite of standard. It's the opposite of uniform. And the existing literature knows that, and so it tries to explain what value means by using concepts like benefit and cost recovery, except benefit is just as subjective. It's just a different word for value. And cost recovery really has to do with policy decisions about how a government's going to finance a particular service, and again, therefore, is not something that's uniform or can objectively be applied across governments. Another problem with the existing exchange non-exchange approach is that what a lot of governments have done is essentially pick some arbitrary percentage to determine what is non-exchange versus exchange-like versus exchange. So, if it was exactly equal value, I think everybody could agree that was exchange. But at what point is it no longer, equal value, or obviously you take $1 away on one side, it's not equal, but effectively, how far down could you go? 90%, 70%, is 50% them? Anything over half, you treat as exchange, and anything half or less is non-exchange. Well, the problem is obviously that there is no guidance on this, and so you have governments picking their own percentages, which undermines comparability. Frankly, even if the board were to say, okay, this is the percentage that everybody should be using, the board really felt that approach, really didn't provide a meaningful distinction, between types of transactions for the purpose of determining how to recognize revenues and expenses related to them. So basically, what you have in this existing literature is a fragmentation of the guidance, because it's possible for two governments to apply the same guidance to the same or very similar transaction and come out with a different categorization, for one to think it's exchange and for another government to believe it's non-exchange. In looking at the performance obligation, no performance obligation approach, I think the primary conclusion that the board had was that it was just too complex. The board was more or less working directly from topic 606, from the FASB, and it really, was a bit too detailed and complicated for these purposes. And the greater the complexity, the greater the possibility that governments aren't going to appropriately apply the standards, which undermines consistency over time and comparability across governments. And the hybrid model, then, that third model that was in the ITC, suffers from all those same problems, because in fact, it suffers from all of the problems, because it's using both a portion of exchange non-exchange and a portion of performance obligation no performance obligation. So in terms of what the board is preparing to propose in the preliminary views, it gets into some serious detail, and I'm going to provide as much of that as I can here, but with the notice that what you have to do this week in the discussion threads, the assignment, the fifth assignment for the course, all relates to the ITC and not what's in the preliminary views. So this you might find useful in terms of critiquing the invitation to comment and writing that comment letter, but you're not going to be tested or given an assignment based upon what I'm about to talk about in terms of the preliminary views. So what the board has decided to do in the preliminary views is to distinguish between what it's calling Category A and Category B transactions, and it's chosen that neutral terminology so that no one thinks that the board has settled on any of the existing approaches that have been discussed so far. This approach might borrow from certain aspects of both exchange, non-exchange, and performance obligation, no performance obligation, but it is very different from either one of them. And so using this terminology is meant to say, just forget all that. Let's start fresh here. And this is where we're really laying out the fundamentals of our approach to revenue and expense recognition. And one of the first things that the PV will do is identify 5 assumptions that the board made in developing the revenue and expense model. The classification of the transaction, the recognition of revenue and expense, and the measurement of the revenue and expense that is recognized. First and foremost, revenues and expenses are equally important in resource flow statements. One is not dominant or superior to the other, and therefore the other is defined based upon the first one. They are independently defined, they are independently important, and the recognition of one doesn't depend upon the recognition of another. For accounting and financial reporting purposes, the government is considered to be an economic entity in these transactions rather than an agent of the citizenry. Now, we of course understand that governments are agents of the citizenry, but when you start to introduce concepts of agency into a transaction, it can make certain aspects of it confusing. What needs to be the focus here is that the government is, a party to these transactions as an entity in and of itself, rather than as a representative of some other entity. The board believes that to the extent possible, it should establish guidance that is symmetrical between the provider of resources and the recipient of resources in cases where governments can be one or both. However, there are certain limitations to that, and so it doesn't. The board doesn't pursue it to the point where it ends up resulting in recognition approaches, for instance, that are less than the best possible ones that the board could come up with, because they just had to make sure that they were symmetrical. So in some transactions, there isn't a symmetrical recognition where the provider has an expense and the recipient has a revenue, or at least not at the same time. But I think you will find as we go through this that a lot of them, in fact, do have that symmetry between the provider and the recipient. And then lastly, from the resource provider perspective, it's important to apply a consistent viewpoint when analyzing the revenues and expenses. And you will see how that becomes important as we start to look at these, that the analysis needs to be done always from that same perspective when you're looking at the provider of the resources, and that perspective that's established should be the same perspective that you are looking at each part of the categorization of the transaction, the recognition of revenue and expense, and the measurement of the amount of the revenues and expenses that are recognized. So the next thing that the preliminary views does is lay out a 4-step process for recognizing revenues and a 4-step process for recognizing expense. And they're basically the same steps, but kind of like negative images of one another. So for revenue recognition, the first step involves asking whether the government has an increase in net assets because of the transaction. And if it doesn't, then there's no transaction to recognize in the context of what we're talking about here. If there is, the second step is to ask whether that increase in net assets resulted in a related liability. If it did, then the government is going to recognize the increase in net assets and a related liability. But it's not going to recognize revenue at this point. If the answer to the question in step 2 is no, then the last question in step 3 is whether that increase in net assets results in an inflow that is applicable to a future period. And if the answer is yes, then the government is going to recognize the increase in net assets and a deferred inflow of resources rather than revenue. And if the answer in the third step is no, that it's not applicable to a future period, it's applicable to the current period, then that's the step. You've gotten through all 4 steps, and in the 4th step, you recognize the increase in net assets and you recognize revenue. And as I said, for expense, it's basically the same. But in this case, does the government have a decrease in net assets? If it doesn't, there's no transaction to recognize in the context of this project. Does the decrease in net assets result in a related asset? If it does, then the government should be reporting a prepaid asset rather than expense. Does the decrease in net assets result in an outflow applicable to a future period? If it does, the government should be recognizing a deferral, not expense. And if the answer is no, if it is in fact applicable to the current period, then the government recognizes expense. We will be walking through those steps in a lot more detail. So if you feel like you maybe didn't catch it all, don't worry. We're really going to follow these in detail. And I'm going to go through some practical examples as well that come out of the preliminary views. So for a Category A transaction, the board believes that the attribute that establishes applicability to a reporting period is the satisfaction of a performance obligation. So answering that question about whether this increase or decrease in net assets relates to the current period or future periods is based upon the government satisfying a performance obligation or its counterparty in the transaction satisfying a performance obligation. And Category B, what is the attribute that's important is compliance with time requirements. If the time requirements have been complied with, if there are any at all, it's related to the current period. If they haven't been complied with, it's related to a future period. And that determines whether there's going to be a reporting of a deferral or a current period revenue or expense. A couple of other things that are important to understand that are part of the fundamentals of the model that the board is proposing. Category A revenue and expense transactions have 2 pieces, an acquisition coupled with a sacrifice, and they are connected to one another. So in a Category A transaction, the government is acquiring something, and at the same time it's giving something up. And that thing it's acquiring it is dependent upon giving up the other thing and vice versa. For Category B revenue and expense transactions, there are acquisitions without sacrifices, there are sacrifices without acquisitions, and there are acquisitions and sacrifices that are not interdependent. So how do you determine whether something is Category A or Category B? There is a second 4-step categorization methodology. It's not a second methodology, it's a second 4-step process. In this case, for categorizing the methodology, as opposed to the 4-step process for recognition of revenue and expense that we just talked about. I'm sorry if that's confusing. It'd be great if they had a different number of steps, but unfortunately they both have 4 steps. So to determine what category a transaction belongs in, we're going to look for 4 characteristics: a binding arrangement, mutual assent between the parties, substantive rights and obligations of each party, and interdependence of those rights and obligations. If a transaction has all four of those characteristics, it's category A. All other transactions are category B. So here's the process laid out in a flow chart with each of these questions or steps or characteristics laid out in order. First, can you identify a binding arrangement in this transaction? If no, it's outside the scope of this project. So we're presuming yes for what we're dealing with here. Is there mutual assent of the parties? Are both parties, willing participants? Have they both willingly entered into this transaction? If no, it's a category B transaction. If yes, you move to the third step. Are there identifiable rights and obligations that are substantive? Meaning they've got, they're not just de minimis. They have economic substance. If the answer is yes, you move on to the next question. If it's no, all it takes is failing one of these to be a category B transaction. So if the answer is yes, then lastly, you're asking, are the rights and obligations interdependent? Meaning, if a government has a right to consideration to receiving payment, that right to receive the payment is dependent upon its obligation to provide service or provide goods to whoever is providing that payment to the government. And likewise, flip that over. The government's right to receive a good or service is dependent upon its payment to the provider of that good or service. Again, if the answer is no, it's a category B transaction. But if it's yes, now you've checked off all four boxes, and that is a category A transaction. A couple of other things to keep in mind. That binding arrangements have a rebuttable presumption of enforceability, which essentially means, if push comes to shove, the parties to the transaction under the terms of the agreement can be forced to perform. They can be forced to make the payment they're required to or to provide the good or service they're required to under the terms of the binding arrangement in the transaction. And it has economic substance, which obviously is important here. If it doesn't, we're not talking about accounting and financial reporting anymore. Mutual assent means that all parties have approved the terms and conditions of the binding arrangement. So all parties may not be happy about it. And so maybe that word willingness is not precisely what you need here. But all the parties have in fact approved the binding arrangement. And those people who did the signing or the entering into of that agreement, they have the power or the ability or the authority to bind the entity that they represent. And then lastly, interdependence of rights and obligations means that the rights are conditioned on the obligations and the obligations are conditioned on the rights. I think I've already explained that in a way that should be understandable. Based upon what we've discussed so far, a quick analysis of the most common existing transactions would likely result in these transactions on the left being category A and these on the right being category B. And if you were to try and overlay exchange, non-exchange, which I encourage you not to do, but it's impossible to stop people from doing that. They want to see how this is different. Well, then things on the left-hand side that would, be non-exchange right now, but would be category A, under this approach: expenditure-driven grants, research grants, and revolving loans. On the opposite side, special assessments, certain regulatory fees like driver's license fees, marriage licenses, professional licenses. Those are things that a lot of governments treat as exchange transactions right now. But if you apply these criteria, and we're going to walk through these and you'll see how they turn out in real life, those would be treated as category B transactions under this approach. So everything we've talked about up to this point in the PV has related to categorization. Remember again, there are three components to the model: categorization of the transaction, recognition of revenue and expense, and measurement. So now we're going to move on to the second component, recognition, and begin by talking about revenue. So in general, a receivable would be recognized when a legally enforceable claim arises in a revenue transaction. That could be at various points. It's not always the same point. It depends upon the type of the transaction and the nature of the binding arrangement. So it could be at one point, it could be the beginning, the end, various points during the life of the agreement. That's something you have to look at, what the terms of the agreement specify in terms of when the parties to the transaction have a legally enforceable claim and therefore can recognize a receivable. Advances in revenue transactions, the board views as resources that are received before a legally enforceable claim has arisen, and therefore would be recognized as a liability, regardless of whether those advances are refundable. So even if the advance that a government has received, is something that it has to return, under certain circumstances, well, that's the easier part. If it's something that it has to return under certain circumstances, you recognize that as a liability right now under all circumstances. But even if it's not refundable, what the board is saying is that it should at least initially be recognized as a liability. So going back to that first set of 4 steps for recognition, this is just a reminder, of what those steps are. Does it have an increase in net assets? Is there a related liability? Is it related to the current or a future period? Those are the questions we're going to be asking. So let's look at category A, revenue recognition first. So we're focused on performance obligations. Remember, I said that that's the key attribute that we're going to be focusing on. So step 1, is there an increase in net assets? So receivables would be recognized when a government satisfies its performance obligations, or as it is satisfying its performance obligations, because at that point, a legally enforceable claim to consideration arises. So the government has performed on its obligations, it's done what it's required to do, and now it has a legally enforceable claim to being paid for, or in some other way compensated for what it has done. Resources that are received prior to the government satisfying its performance obligations are an advance and would be recognized as a liability. Step 2, is there a related liability? The point that the board makes in the preliminary reviews is for category A revenue transactions is that in the absence of an advance, there are no liabilities here. The only liability would be an advance in these transactions. The performance obligations themselves are not liabilities. Step 3 is the inflow applicable to a future period. As I mentioned earlier, it's satisfying that performance obligation that will tell you whether the inflow is applicable to the reporting period or to a future period. If a government has satisfied its performance obligation, then it's related to the current period, and if not, it's related to a future period. And as a result of this, there are no deferrals here. If the government has received the resources in advance, it's a liability. But if it hasn't received any resources yet, and it hasn't satisfied its performance obligations, there's nothing to recognize yet. There's no liability, there's no receivable to recognize. So ultimately, what it means is that for category A transactions, there are no deferred inflows or outflows of resources. And then step 4, do we recognize an asset and revenue at this point? And so we're going to recognize it, the revenue with the receivable as or when the government has satisfied the performance obligations, either over time or at a specific point in time. And you know that a government has satisfied its performance obligation when it transfers control of a resource to its counterparty or to a third party that is involved in the transaction. So that's the key to understanding when the performance obligation has been satisfied, that whatever resource is involved that's being transferred from the government to another entity in exchange for consideration, that control of that resource passes from the government to one of the other parties to the transaction, usually the counterparty, but sometimes it may be a third party that is maybe not the provider of the consideration. It may be the counterparty that provides the consideration, but the government then provides the goods or services to a third party. For Category B revenue recognition, it's the same steps again. Is there an increase in net assets? If there is, then you have a receivable to recognize when a legally enforceable claim arises. And determining when a legally enforceable claim arises depends upon what subcategory of Category B transaction you're talking about. And the preliminary views will identify 5, and I'll walk through each one of those momentarily. Step 2, is there a related liability? Resources that are received before the establishment of that legally enforceable claim would be recognized as a liability. They'd be considered advances. Step 3, what period is the inflow applicable to? As I mentioned earlier, the attribute that's important here is compliance with time requirements. And so there can be deferred inflows of resources in Category B revenue transactions, unlike Category A. So, if a government has recognized an asset like a receivable, and that inflow is subject to time requirements, and it has not yet complied with those time requirements, that means the inflow is related to a future period, and it should be recorded as a deferred inflow of resources rather than as revenue. And then you get to the last step, and as the government complies with the time requirements, that's when you're going to recognize revenue. And in the absence of time requirements, then you're going to recognize revenue when the legally enforceable claim arises. So, not all Category B transactions have time requirements. Many of them don't. And so if there is no time requirement, whenever the legally enforceable claim arises, the point at which the government's going to recognize the asset, in most cases a receivable, at that point, it should be recognizing the revenue as well. As I mentioned, there are 5 Category B transactions that are identified in the PV, or will be identified in the PV. And the determination of when the legally enforceable claim arises varies depending upon the type of transaction. There are some significant similarities to the existing non-exchange transaction categories here, but then there are also some that aren't specifically identified as separate categories in the existing guidance. The first is derived revenue, so we're talking about sales taxes, income taxes, all taxes basically except for property taxes. And for that, the PV says that receivables should be recognized when the underlying transaction or activity that is being taxed has occurred. So when the retail sale occurs, when income is earned, and so on. That's the point at which the legally enforceable claim arises, and a receivable should be recognized. For imposed revenue, so property taxes, fees and fines, those are imposed revenues just as they are right now in Statement 33 on non-exchange transactions. But for property taxes, rather than focusing on the levy or lien date, which we know from the last lecture is one of the sources of problems and challenges for governments under the existing standards, the board is proposing to recognize a receivable at what it's calling the imposition date. That's when the governing body approves an ordinance or some similar legal action that specifies the property tax rate or the total property tax amount that citizens are expected to provide for a specific fiscal period. So that at that point, regardless of what you call that, regardless of whether that's the levy date or the lien date, who cares? That point at which the government has taken this legal action to specify this is what citizens are going to owe for this particular period, that's the point, that's the imposition date, that's the point at which the receivable should be recognized. For regulatory fees, and now this is a level of detail that doesn't exist, distinguishing between two different types of fees, regulatory fees and punitive fees. For a regulatory fee, the board is proposing that the receivable and the revenue would be recognized when the individual or entity engages in or applies for a permit to engage in the activity upon which the government has imposed a fee. So here we're talking about licensing. Driver's licenses, marriage licenses, professional licenses, and so on. For punitive fees, things like parking tickets and speeding tickets and so on, the government would recognize the receivable and the revenue when, pursuant to due process of the law, it can be established that an individual or entity has committed or omitted an act that is a violation of the law for which the punitive fee is prescribed by the governing body's legislation. So at the point at which it can be determined that they are guilty, I suppose, is the way I would summarize that. That's when the government can recognize a receivable and revenue. Not when it writes the ticket. It actually has to, there has to be some confidence here, I think, that in fact the entity that the punitive fee was applied to is in fact responsible for making that payment. The third category B transaction subcategory is called contractual binding arrangements. A contractual binding arrangement is when two or more willing parties enter into an agreement in which there is an explicit binding arrangement that provides for the transfer of resources between the parties. This can be both a revenue and expense transaction. So the two we've just talked about are only revenue, but governments can be on both the revenue or expense side of these transactions. Examples include donations, pledges, payments in lieu of taxes by not-for-profit entities, and perhaps, most notably, purpose-restricted grants that have a grant agreement. In general, these types of transactions are receivably recognized based on the terms and provisions in the binding arrangement. That arrangement will specify when that legally enforceable claim arises and the point at which the recipient can, of the grant, for instance, can recognize a receivable related to that grant. For pledges, a government that receives a pledge would recognize a receivable when the promise is made and that promise is verifiable, measurable, and probable of collection. And that is regardless of whether there's a time requirement associated with it, in terms of when those pledged amounts can be spent or when those pledged amounts are required to be provided to the government. For pledges that are contingent upon the government providing a match, contributing additional funds, the government would recognize a receivable when it has addressed whatever those contingencies are that are specified in the binding arrangement. And then lastly, if a pledge includes time requirements, there would be a recognition of a deferred inflow of resources to go with the recognition of the receivable until the government begins to comply with whatever those requirements are by holding, investing, and preserving those resources for the specified purposes that are identified in the binding arrangement. The fourth category is general aid to governments, and this is a situation where legislation requires one government to provide resources to other governments to fund a specific program. Um, so this involves the resource provider appropriating resources annually, biannually, just on a periodic basis, and then distributing those resources to the other governments, usually based upon a specified formula. So the most common example of this is state aid to school districts. So in these transactions, the government or the school district, for instance, if we want to use the state aid to school district example, would recognize a receivable in revenue when payments are due to the district if both of the following criteria are met. First, the resource provider has appropriated the funds for provision of the resources, and the period that that appropriation is applicable to has already started. And second, that the resource provider has determined that it intends to provide the resources to the resource recipient. Generally, that involves communicating to the resource recipients that it's going to provide those resources. If either of those is not met, it's not the appropriate time for the school district or other recipient of the general aid to be reporting a receivable in revenue. If the resource provider cancels its appropriation and communicates the cancellation to the recipient, then there are two possible outcomes here. One, the recipient should continue reporting the receivable in revenue if the resource provider has said it's going to make that payment in a subsequent period. But if the provider says it's not going to make that payment, then the recipient should no longer be recognizing a receivable or revenue for that payment. And then the last of the 5 subcategories of Category B transactions is shared revenue. So, usually we're talking about a state government here that has a revenue source and it splits it with some of its local governments. It's often a sales tax that is the focus of these shared revenue transactions. So the resource provider basically has 2 transactions here. They impose a tax like a sales tax, and that's one transaction. And then the sharing of the tax revenue with counties or localities or whoever, is the second transaction that's involved here. So again, this can be both revenue and expense transactions, just like contractual binding arrangements, just like general aid to governments. There is in the governmental arena, there's an expense side to that and a revenue side. So in terms of the way that this would work is that if those shared revenue transactions are supported through periodic appropriations, much like general aid to governments that we just talked about, then the resource recipient, the school district, the county, whoever it is going to follow the same pattern of recognition that was proposed or is going to be proposed for general aid to governments. If, however, these transactions are based on continuing appropriations, then in those situations, a recipient's going to recognize a receivable when the underlying transaction that produces the shared revenue has occurred. If the resource provider has appropriated the funds and the period applicable to the appropriation has begun, and the resource provider has determined that it intends to provide resources to the resource recipient. So that has similarities to those circumstances that are identified for general aid to governments in terms of the resource provider has appropriated, there's evidence they've appropriated the funds, they've communicated that they're going to provide these funds to the recipient governments, and the period that resource provision applies to has already started. You're in that period now. In terms of expense recognition, a government's going to recognize a payable when a present obligation to sacrifice resources arises in an expense transaction. And as we've already highlighted, advances in expense transactions, or when the government is providing resources in advance of the counterparty satisfying its performance obligation, and those should be recognized as a prepaid asset, regardless of whether those advances are refundable. So there's some symmetry here. In the revenue transactions, we were talking about advances being reported as liabilities, regardless of whether they're refundable. And in this case, as advances made by the government, payments it makes in advance of its counterparty satisfying its performance obligations would be recognized as prepaid assets as well. And just a reminder, what those 4 steps look like in expense recognition. So for Category A expense recognition, is there a decrease in net assets? So you're going to recognize a payable when the counterparty satisfies its performance obligation or as it is satisfying its performance obligation. So again, you can see the symmetry here, where you're basically just flipping the script from government to counterparty. Step 2, if the resources are provided prior to the counterparty satisfying its performance obligations, that's an advance, and it would be recognized as a prepaid asset. You know that whether the outflow is applicable to this period or a future period based upon satisfaction of the performance obligations by the counterparty. And therefore, just like with the Category A revenue transactions, there are no deferrals. There are no deferred outflows in Category A expense transactions because either the counterparty has satisfied the performance obligations or it hasn't. And then lastly, step 4, liability and expense are recognized when or as the counterparty is satisfying its performance obligations, either at a point in time or over time, depending upon the terms of the binding agreement, and that that the counterparty has satisfied its performance obligation when the government receives control of a resource from the counterparty. For Category B expense recognition, you're going to recognize a payable when a present obligation to sacrifice resources arises based upon, in this case, 3 subcategories of Category P transactions. We looked at 5 already, but 2 of them are only revenue transactions. So we're going to look again at those 3 transactions that can be either revenue or expense. But the thing that's common in them is it's when the present obligation to sacrifice resources arises. That point at which that arises differs depending upon the type of transaction. Just like when we were looking at the Category B revenue transactions, we were looking at when the legally enforceable claim arises. Resources that are provided prior to the establishment of a payable should be recognized as a prepaid asset. And then knowing what period it relates to depends upon whether there are time requirements, and if there are, whether those time requirements have been satisfied. And if there are time requirements and they haven't been satisfied, then there is a deferred outflow of resources that needs to be reported rather than expense. But otherwise, expense is going to be recognized when the payable is recognized. So looking at the 3 Category B transactions that have an expense side to them, for contractual binding arrangements in general, payable is going to be recognized by a government based on the terms and provisions of the binding arrangement. For general aid to government, you have these criteria that are still required. So the resource provider is recognizing a payable and expense when payments are due if both of these criteria are met, that the resource provider has appropriated the funds, the period applicable to the appropriation has begun, and the resource provider has determined that it intends to provide the resources. And then in instances where an appropriation has been canceled and communicated to the recipient, the recognition depends upon whether the provider is going to make that payment in a subsequent fiscal period. And if it is, then the recipient continues to, then the provider continues to report the payable and expense. But if it said, we're never giving you this money, then it should no longer be reporting a payable or expense related to that payment. Lastly, shared revenue, and this is symmetrical with the revenue side of the transaction. On the expense side for the provider, if the transaction is supported through periodic appropriations, then you're going to use that same approach we just talked about for general aid to governments. And if it's supported or based on continuing appropriations, then the provider has a payable and an expense when the underlying transaction that produces the shared revenue has occurred. If it's appropriated funds for the provision of the resources, the period that the appropriation is applicable to has begun, and it intends to provide the resources to the resource recipient. I'm sure your head is spinning right now. Mine is too, and I've read this stuff a whole bunch of times already, and I think understand it. So don't feel bad if you're just kind of like, wow, that's an awful lot to swallow. I've just covered the lion's share of the revenue and expense recognition model, in a relatively short period. The third component of the model is measurement. I'm not going to get into this in a tremendous amount of detail because that's really not the primary focus of the PV. But unlike the ITC that didn't get into measurement at all other than identifying it as the third component of the model, the PV does talk about how government should approach measuring the items that it is recognizing in these revenue and expense transactions. The principal concept here is that measurement should be based upon the most liquid item in the transaction. So for revenue transactions, you're measuring them based upon the amount of consideration that has been received or is receivable, whatever the asset is. And for an expense transaction, you're measuring based upon the amount of consideration paid or payable. In other words, whatever the liability is in the transaction. Collectability is also an issue with respect to measurement. You're not going to recognize revenue unless the amounts are probable of becoming uncollectible and are not probable of being, and you wouldn't include amounts that are probable of being refunded either. Let me restate that because I think I confused myself in the middle of it. So when you're recognizing revenue, there are two amounts that you shouldn't include. You shouldn't include amounts that are probable of becoming uncollectible, and you shouldn't include amounts that are probable of being refunded. So generally, uncollectible amounts are recognized as an allowance and a reduction of revenue, and that would continue. But if there's no revenue to base collectability on, for instance, if you're talking about a loan receivable, then the uncollectible amounts would be recognized as outflows of resources, kind of like a bad debt expense. Amounts that are probable of being refunded would be recognized as a liability. So let's take a look at some examples. When you see the preliminary views, you will see that there's something like 15 to 20 examples in there that the staff has produced really detailed cases on that show you how you would apply this comprehensive revenue and expense recognition model to those transactions. And I'm only going to look at a few of them so that you get a sense of the various outcomes that you might have by applying the categorization methodology, the recognition methodology, and then the measurement guidance. So let's start with a healthcare procedure. We have a public hospital that has a June 30th fiscal year end. The hospital provided an inpatient surgical procedure in June of 2021, so the last month of the fiscal year. and that procedure required it to transfer numerous goods and services to the patient, such as a room, meals, nursing care, physician services, therapy services, medication, and so on. The hospital bills $59,000 for the procedure and estimates that $10,000 of that amount will not be collected. So those are the basic facts and circumstances of this transaction. So let's walk through the categorization of the transaction to determine if it's category A or category B. So is there a binding arrangement? There absolutely is. When a patient is admitted to the hospital, they're going to fill out all kinds of paperwork, and that's going to detail what their responsibilities are, what the hospital's responsibilities are, and that paperwork, it has a legally enforceable aspect to it. Is there identification of mutual assent between the parties of capacity? Nobody's forcing that patient to go get that surgical procedure. The fact that they filled out the paperwork voluntarily, means that that there is mutual assent. The fact that the hospital admitted the patient shows that they've assented to it. Parties of capacity means we're talking about an adult here, somebody who has the right to check themselves into a hospital for a procedure, not a minor. Step 3, identification of substantive rights and obligations of each party. The hospital has a right to be paid and an obligation to provide the surgical services and everything else that goes with it. The patient has a right to receive those services and an obligation to pay the hospital. And then determination of whether the rights and obligations are interdependent, absolutely. The government's, the public hospital's right to payment, to consideration, is based upon it providing the services, meeting its its performance obligation. And similarly, the patient's obligation to pay is conditioned upon receiving the services that it was promised. So this is a Category A transaction. So, for recognizing revenue on a Category A transaction, the hospital is going to recognize a receivable and revenue as it satisfies the performance obligation by providing the specified services. And as the PV explains in some more detail than I'm going to get into now, in instances where the counterparty to the transaction is receiving and consuming the goods or services at the same time, that results in revenue being recognized over time as the obligation is satisfied. So in this case, the patient is receiving and consuming those services from the hospital at the same time. It doesn't receive the surgical procedure and then consume it at a later time. They're coincidental. They happen at the same time. Revenue and expense would be measured based on the most liquid item, which in this case is the receivable that the hospital is recognizing. So it's going to recognize a receivable for the full amount it billed of $59,000, but have an allowance for uncollectible amounts of $10,000, and therefore recognize revenue of $49,000. That's a fairly straightforward transaction. Here's one that's a little bit more complicated, in part because we're going to look at both sides of the transaction. There's a government on the expense side and a government on the revenue side. So you have a state government and a county government. They both have June 30th fiscal year ends. The state has agreed to provide a grant of up to $500 million to the county so that the county can build a bridge, which it expects to do within the next 2 years. The grant agreement is signed by representatives of both governments, and those representatives have the ability to bind the governments they represent. The county submits quarterly reimbursement requests for allowable costs related to architecture, engineering, and construction, and the state commits to reimburse 90% of those allowable costs. So those are the basic facts and circumstances of this transaction. Now, prior to issuing its June 30th 21 financial statements, the county gets invoices of $30 million from the architectural and engineering firms for work that they performed in June 2021, so during fiscal year 21. The construction vendor, they know that they began work. The county knows they began work, but they hadn't yet submitted an invoice for the work they performed in June, so the county applies its professional judgment and estimates that the construction work performed in June totaled $10 million. The state ordinarily remits payments to local governments within 2 weeks of the end of the period to which a grant reimbursement relates. So the county anticipates that it's going to submit its first request for the June 1st to August 31st, 2021 period on September 15th, 2021, and receive payment from the state before October 1st, 2021. Okay, there's a lot to swallow here. Here are the basic points. The works performed in June during the fiscal year 2021. The government either has a bill or used its professional judgment to determine what those allowable costs are that it's going to seek reimbursement for. So even though it hasn't yet sought reimbursement for it, it knows what those amounts are before the end of the fiscal year, and it's related to work performed before the end of the fiscal year. So let's categorize the transaction. Identification of a binding arrangement, there definitely is one. The grant agreement is a binding arrangement, and it has legally enforceable provisions in it that the parties to the transaction are going to be required to perform. Is there mutual assent between the parties of capacity? Yes, they both agreed to this grant agreement. They both signed the agreement. Their representatives signed it. So there is mutual assent. Is there identification of substantive rights and obligations of each party? There are. The county has a right to receive the grant payments, when it incurs allowable costs, related to building this bridge. Determination of whether the rights and obligations are independent, yes. The county's right to receive that grant payment is contingent upon it incurring allowable costs related to the construction of the bridge. So this is a Category A transaction, a Category A expense transaction for the state, and a Category A revenue transaction for the county. So the county is going to recognize a receivable and revenue, and the state's going to recognize a payable and expense as the county satisfies the performance obligation. And the way it does that is by incurring these allowable costs in compliance with all of the applicable requirements of the grant. Revenue and expense is going to be measured based on the most liquid item. So the county is going to measure the receivable, and the state is going to measure the payable by considering the amount of allowable costs that were incurred and the established grant reimbursement rate. And the county has determined that the entire amount of the receivable is probable of collection. So there's no issue of collectability here. So the county recognizes a receivable and revenue of $36 million because the allowable costs total $40 million and the reimbursement rate is 90%. And the same on the flip side, the state is recognizing a payable of $36 million. Third transaction, college tuition. We're looking at a public college that has a June 30th fiscal year end. It has a 16-week fall semester that's conducted between August 19th and December 13th, 2021. Registration begins on June 14th, 2021. So the fall semester is in fiscal year 2022. Registration starts in fiscal 2021. And on June 20th, 2021, during fiscal year 2021, a commuter student registers for 12 credit hours and makes a non-refundable tuition deposit of $160. That's 10% of the total $1,600 fee. The remaining tuition fee of $1,440 is billed to the student at that time and is due August 5th, 2021, so 2 weeks before the start of the fall semester. Students may withdraw from any class before August 21st, 2021, and receive a refund except for the 10% non-refundable deposit. So let's categorize the transaction. Identification of a binding arrangement. When the student enrolls, fills out whatever paperwork they have, at that point, you've got a binding arrangement between the public college and the student, and that's a legally enforceable agreement. If the student pays for their tuition, then they're entitled to receive that education, and if the school is providing the education, it's entitled to the tuition payment from the student. Identification of mutual assent between the parties of capacity, presuming that this is an adult, this commuter student, and who has the ability to enter into a binding arrangement on their own without parental consent, then yes, there is mutual assent between the parties of capacity on the part of the student by filling out the registration forms, on the part of the university by accepting those registration forms, processing them, and accepting the deposit payment of $160. Substantive rights and obligations of each party, absolutely. The college has a right to receive tuition payments and an obligation to provide education, to run those classes and allow the student to attend. The student has an obligation to pay the university the tuition, and it has the right to attend classes. And those rights and obligations are contingent upon one another. They're interdependent. The college's right to the tuition is contingent on it providing an education, allowing the student to enroll in those classes. And on the flip side, the student's participation in those classes is contingent upon the student paying his or her tuition. So this is a Category A transaction, a Category A revenue transaction for the public college. Because the student receives and consumes the services simultaneously, revenue should be recognized over time rather than at a single point in time. The college would not recognize a receivable at the time it bills the remaining tuition, however, because it doesn't have a legally enforceable claim at that time, and therefore it doesn't control the resource, that $1,440 that it will be owed when the semester begins and the student enrolls in the classes. Revenue would be measured based on the most liquid item, the prepayment. They've actually received $160. And collectability is not an issue here. If the student doesn't pay, the student doesn't go to class. It's as simple as that. So as of fiscal year ending June 30th, 2021, the college would have recognized cash and revenue of $160 related to the deposit. And then it receives cash in the amount of $1,440 on August 5th, 2021. Now we're in fiscal 2022. And it recognizes that amount as revenue over the course of the fall semester as services provided. So that by the time you get to the end of fiscal year 2022, the college has recognized revenue in that fiscal year of the full amount of the cash payment, $1,440. Last transaction, general aid to schools. So state government and its school districts both have June 30th fiscal year ends. A state appropriation is established on May 2nd, 2020 that allocates $40 million to a specific school district for the fiscal year ending June 30th, 2021. So we're in fiscal year 2020 right now, May 2nd of 2020. This appropriation is for the fiscal year that begins on July 1, 2020 and ends on June 30th, 2021. The state makes its payments to school districts in quarters on the 15th day of September, December, March, and June. Those are the facts and circumstances of this transaction. So let's categorize the transaction. Is there a binding arrangement? There absolutely is. The legislation that governs this transaction, the provision of this aid to the school districts, is legally enforceable. The appropriation has legal aspects to it as well. So there definitely is a binding arrangement here. Identification of mutual assent between parties at capacity, no. Certainly the state is, has assented to this transaction, but the school districts, although they're probably very happy to receive this revenue and are receiving it willingly, they haven't entered into any transaction with the state. They haven't signed any agreement. They haven't. They weren't a party to a contract or other document that specified the terms of this general aid. So all it takes is failing one of these steps for it to be a Category B transaction. So for the state, it's a Category B expense transaction, and for the school district, it's a Category B revenue transaction. So the state recognizes a liability and the school district a receivable when both of the following are true. When the state has appropriated the funds, so we know it's done that, May 2nd, 2020, and the period applicable to the appropriation has begun. That's July 1, 2020. So it's not going to be recognized at May 2nd, but could very well be recognized as of July 1, as long as the state has determined it intends to provide the resources. I'm sure that's been communicated already. The school district is aware of the appropriation that has taken place. So the liability and the receivable would be recognized on July 1. Not on July 1, but when the payments are due after July 1. So the first one is due on September 15th. So as of September 15th, the state has a payable and an expense, and the school district has a receivable and revenue, because that's when the legally enforceable claim arises, the due date of each of those four payments. And the governments would measure those for the state based on the payable, because that's the most liquid item in the transaction, and for the school district, the receivable. So as of June 30th, 2021, the state will have recognized a $40 million expense because because the due dates for all four quarterly payments have passed, and symmetrically on the other side, the district will have recognized $40 million in revenue. So I'm sure you're glad the lecture's over. That was an awful lot to swallow. You may want to listen to this again. You may want to look over the slides again. But I will remind you again that you don't need what I covered in this part of the lecture to participate in the discussion threads this week or to do assignment number 5. Although, I think that there are some key points that you could use to comment on the proposals in the ITC based upon what you've heard in this lecture about what the board has done in the time since the ITC was released for public comment.